You know what's funny? Just a few years ago, if you told a room full of investors that green energy would become one of the biggest wealth creation opportunities on Earth, most of them would have laughed. Seriously. They would have pictured money-losing startups, government subsidies, overpriced solar companies, and endless promises that never turned into profits. And honestly, for a while, they weren't completely wrong. But while everyone was busy arguing about whether sustainability was real or just another buzzword, something enormous happened right under Wall Street's nose. The global green economy quietly crossed a staggering $10 trillion in market value. Not billion, trillion. And here's the part that should make every investor pay attention. That market is now larger than the entire global oil and gas sector combined. Think about that for a second. For over a century, oil dominated the global economy. Wars were fought over it. Countries built fortunes around it. Entire stock market empires were created because of it. And now, for the first time in modern history, something else is starting to rival that influence. This isn't a trend anymore. It's not a political debate. It's not a feel-good movement. It's capital. Massive amounts of capital. And wherever capital flows, opportunity follows. So today, we're breaking down exactly what's happening, why Wall Street is paying attention, which US companies are benefiting the most, and most importantly, how investors can separate real opportunities from expensive hype. Let's get into it. When most people hear the phrase green economy, they immediately think about electric vehicles, Tesla, charging stations, maybe a few solar panels. That's it. But the reality is much bigger. The green economy today isn't about building a better car. It's about rebuilding the entire operating system of modern civilization. Energy generation, energy storage, power transmission, smart grids, industrial efficiency, sustainable agriculture, water management, carbon capture, battery technology. The list keeps growing. And that's exactly why the opportunity is so massive. Because we're not talking about one industry, we're talking about dozens of industries all moving in the same direction. At the same time, the United States, Europe, China, India, the Middle East, everyone is investing billions trying to modernize infrastructure for the next generation. And unlike previous green energy booms, this one isn't being driven purely by environmental goals. It's being driven by economics. Renewable energy has become cheaper. Battery technology has improved. Efficiency has increased. For many projects today, going green simply makes more financial sense. That's why institutional money is flooding into the sector. BlackRock, Vanguard, massive pension funds, sovereign wealth funds. They're not investing because they're trying to save the world. They're investing because they're trying to generate returns. And that's a very important distinction. Wall Street follows profit, always. Now let's talk about the companies benefiting from this shift. And yes, we have to start with Tesla. Whether you love Elon Musk and or can't stand him, it's impossible to ignore what Tesla has built. But here's something many retail investors still don't fully understand. Tesla is gradually becoming less of a car company and more of an energy company. Most headlines focus on full self-driving, robo-taxis, humanoid robots, social media drama. But behind the scenes, Tesla's energy storage business has been growing rapidly. Its Megapack systems are helping stabilize electrical grids around the world. And that's a huge deal because renewable energy creates one major challenge: storage. The sun doesn't shine 24 hours a day, the wind doesn't blow constantly, which means energy has to be stored somewhere. That's where large-scale battery systems come in. And demand for those systems is exploding. As countries continue expanding renewable infrastructure, battery storage becomes increasingly valuable. That's a trend investors should pay very close attention to. But maybe Tesla feels too volatile for your taste. Fair enough. Let's look at another giant. NextEra Energy. If Tesla represents growth, NextEra represents stability. The company is one of the world's largest producers of wind and solar power. And unlike many high-growth startups, it generates consistent cash flow. What makes NextEra fascinating is that it combines utility-like reliability with long-term growth potential. As electricity demand rises, especially from AI data centers, companies like NextEra become increasingly important. Because all that artificial intelligence everyone is excited about, it needs power, a lot of power, much more than most people realize. And this brings us to one of the most overlooked investment stories in the market right now: the collision between AI and clean energy. Everybody talks about NVIDIA. Everybody talks about AI software, but very few people talk about what powers the entire system. Data centers consume enormous amounts of electricity. Every AI query, every AI image, every AI video, every AI model training run, it all requires energy, and lots of it, which means someone has to build the infrastructure, someone has to modernize the grid, someone has to manufacture the transformers, someone has to distribute power, someone has to make sure electricity actually reaches those facilities. And that's where companies like Eaton Corporation and GE Vernova enter the picture. These aren't flashy stocks, but they're providing the equipment that keeps the modern energy system running. It's the classic picks and shovels strategy. During a gold rush, the people selling shovels often make more money than the people searching for gold. Now, before you rush out and buy every green energy stock you can find, we need to talk about risks, because there are plenty, and this is where many investors get burned. The first risk, valuation. A great company can still be a terrible investment if you pay too much for it. The second risk, debt. This industry requires massive amounts of capital. Building renewable infrastructure isn't cheap. Building transmission networks isn't cheap. Manufacturing batteries isn't cheap. When interest rates rise, highly leveraged companies often struggle. We've seen this before. Some solar companies looked unstoppable during the last boom cycle. Then financing costs increased, debt payments rose, profitability disappeared, and investors got crushed. That's why balance sheets matter. Cash flow matters, profitability matters. If a company depends entirely on subsidies to survive, that's a warning sign. If it consistently burns cash with no path to profitability, that's a warning sign. Investing isn't about buying exciting stories. It's about buying sustainable businesses. So what's the big takeaway here? Simple. The $10 trillion milestone changes the conversation. Sustainability is no longer a niche investment theme. It has become one of the largest economic transformations of our lifetime. The question isn't whether the transition is happening. The question is, who captures the value? Now, I'm curious, do you think green energy is still in the early innings, or has the market already gotten ahead of itself? Drop your thoughts in the comments. If you enjoyed this breakdown, hit the like button, subscribe for more Wall Street deep dives, and I'll see you in the next one. Take care.